Corporate finance practice problem using Onenote. Bond coupon rate, current yield, and yield to maturity. Get ready, it's time to take your chance with corporate finance. Here we are in Onenote. If you have access to Onenote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab, then down in the 1611 Bond Coupon Rate, Current Yield, and Yield to Maturity tab. Also note, when using Onenote, look at the Immersive Reader tool. Many of our presentations up top will be mirrored in the text area. Same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we're going to be calculating the bond coupon rate, the current yield, and the yield to maturity. Now, the current yield is going to be a type of performance type of calculation. It's an easier type of performance type calculation. And then the yield to maturity is maybe a more in-depth. It takes in the whole breadth of the bond up to the maturity. And we'll see how those things will differ. In future presentations, we'll do some more comparisons between the current yield and the yield to maturity. Now, these two are where our comparison will be. These are the new type of things that we'll take a look at. The yield to maturity is something that we looked at in prior sections when we focused in on bonds in particular. We're going to go through them a little bit faster here. If you want to see them in a little bit more depth, take a look at the prior section where we focus simply on the bonds. We might do some calculations there in a couple different formats, including tables and including mathematical formulas possibly for the present value calculations. If you're looking here for present value calculations, then take a look at a prior section. You might want to look at the present value calculations there, where we focus simply in on present value calculations and the different formats we can have for them. Here, we're going to do the comparison between these two, and we're also going to look at an estimate for the yield to maturity, which will be another formula that we can consider. Okay, so we have the bond outstanding, par value $1,000, annual interest payment $90, market price is going to be the $800, maturity in years is going to be the 10%. So notice what we don't have is the yield to maturity, or what we could call the market rate. We'll calculate that and compare it to the current yield. So first, let's look at the coupon. We weren't given that, but we were given the $90. So if we have the annual interest payment, comparing that to the par value of the $1,000, that gives us our coupon rate of the 9%. That being the rate we can imagine like on the bond or part of the bond. And that's going to be 0.9 or 90%. Then I meant to move the calculator. Instead, I squished it up there. We got the current yield. This is our basic kind of performance calculation, comparing the $90, what we would expect to return if we were to invest in the bond, comparing it to the market price, what we're going to pay for it, the market price. And that'll give us our straightforward type of performance calculation, the return we would have in essence on that year, for each year. And that would be the 90 divided by the 800, 0.1125 or 11.25%. So then we want to make that comparison to the current yield calculation to the yield to maturity calculation. And I find, of course, a lot of young accounting or finance professionals have trouble with the concept of yielding to maturity, the yield to maturity. So we'll do that calculation a couple times down below. We'll do it in a straightforward method with a kind of backing into it, which would use a tool called GoalSeek in Excel, which I think is the more intuitive way to see it. And then we'll do a rate function, which we could see in Excel. And then we'll do another estimating type of format that we could do mathematically, which you might see in some textbooks. We'll do two formats of this, which will give you an approximation of the yield to maturity. So first, let's do this with our calculation, which would be a GoalSeek type of calculation. And the way I would think about this is to think first about what if we had the amount of the yield to maturity and we're calculating the market price. Most of the time, that's the way people have seen this. They've done this type of calculation if they have worked with the bonds. And even if you get the rate, you still want to double check it typically with this type of calculation. In that case, you would take the present value of the interest, the annuity payments that you would be receiving, that being the $90 in this case for the 10 years, and then the present value of the value of 1 at the end of the period being the 1,000 at the end of the 10 years. And you would use that using the market rate if we had the market rate. If we don't have the market rate, then we can use Excel to kind of back into that by using the present value formula formulas as we normally would, apply an estimate. In this case, this is the actual answer, but we can think about applying an estimate first, say like 10%, and then adjust this estimate in order to then find what the end result needs to be. So we can back into it using the concept of algebra as finding that one unknown in the formula while still using functions in Excel, which would be easier to do. So if we were to do that, we'd have the first item here, the present value of the interest, the formula looking something like this. Present value, we would be taking the rate. That's this rate here, which is the answer. But if we didn't know the answer, we could start off with like 10% here or some other number, comma, number of periods. The number of periods would then be the 10 for the years, comma, and then the payment is going to be the $90 per year. That would be an annuity calculation. In this case, getting to the $496 about. Then we have the present value of 1. That's going to be this $1,000 that we're going to bring all the way back. Formula looking at something like this, present value of 1 formula. Again, if you want to see other ways to calculate these present value calculations, take a look at a prior section when we focus just on present value calculations. Here's the Excel formula for it. Negative present value, we take the rate, in this case the 12.63. Notice that's the answer, but you could imagine it being 10%. You could see that same item is in both of these functions, and it's going to be needed to get to the bottom line number. So then we're going to say, comma, number of periods is going to be 10, comma, comma, because it's not an annuity, present value of 1. The future value that we're bringing back would be the 1,000. So then that's going to give us the 304. Adding the 496 and the 304 gives us then the 800. That's the answer. That's what we knew it needed to be. The 800, the end result. Again, we had the 12.63, which is basically the answer. But if we didn't know that answer and we started with 10%, then we can test or change the cell until we get to the number we need to get to for the end result, the 800, to be 800. And we could use something called goal seek in order for us to do that more quickly, to allow Excel to say to Excel, in essence, would you please change this cell, this percent, given it's included in these two items and is a function of or part of the calculation of this 800. Change that to whatever it needs to be in order to get the end result to be the market price. The reason I think this is useful to do is because it's the way most people think of the bond calculation when they calculate the market price. And even if you use a rate function to get the rate, then you'd still want to check it by then plugging it back into this calculation to double check that you get the proper amount. Now the rate function looks like this, so you could do the same kind of thing with the rate function in Excel. The rate function would be equal to the number of periods, in this case 10, comma, the payment, which has to be negative, and that's a crucial point to get in this formula right. You got to get the negative payment, which is going to be the $90, and then comma, and then we have the present value. The present value is the current price, the 800, and then we have comma, the future value. The future value has to be negative. That would be the 1,000. And then we have 0 to indicate that it's at the end of the period calculation. So that's going to be a function just to tell us how it's going to calculate. And that would then also get us the 12.63. Notice you need a couple negative numbers here. And I don't feel completely confident with this 12.63 unless I was to double check it with my present value calculation. So even if you did the rate function first, in other words, I would still double check it by doing my normal kind of calculation up top to see if I get to the proper market price for that double check. So then if we do it again, this is the new thing. We could do an approximate of it with a formula. Now there's a couple ways that you may see this formula. It's kind of a complex looking formula just because there's a lot of division components in it. But if you do it a couple times, it's not too bad. And we'll have a couple variations of it as well. So C is going to be the coupon or the interest payment plus F minus P, and that's going to be the face amount minus the price over N, which is going to be the years to maturity, over F or the face amount plus P, which is the price, divided by 2. This numerator, we're going to have a slight variance to it on the first one, which actually makes it a little bit more accurate. And then we'll show this one, which is a little less accurate. So we expect to get to this calculation about so it's not going to be exact. It is an approximation. So I'm going to set this up in a table type of format. I really think this is useful to do in Excel. If you could take a formula like this, especially one that's kind of as complicated as this with all the division problems, and think about how you might plug it into a worksheet, that's something that you may often do when you're working with Excel. A lot of times you could put the numbers directly into this formula and do it algebraically, of course. You might want to work on basically Excel sheets and see if you can see how you would format something like this. Looks very complicated into basically a table type of format that you can work through in an Excel worksheet, because in practice, that could be a useful skill to have. So in any case, we have the annual interest payment. Notice what I want to do is I want to have these two numerator and denominator in the outer column, and then I'm going to put every added calculation inside. So basically this C on the numerator, I want to have it kind of by itself so I can do the more complicated F minus P over N. So I'm putting that in this cell. That's the annual interest payment. Then I'm going to work on this F minus P, which I'm going to do in its own sub-calculation. F is the face amount. That's the 1,000 of the bond, minus P, which is going to be the price, which was the $800. $800, subtracting those out, that gives us the 200. So we got to this component now, the 200. Notice I put that in the outer column. Then I'm going to divide that by the number of periods, which is 10 years to maturity. So we'll divide that out. 200 divided by 10 is 20. Now we have the C and we have this whole thing in the same column, right? Those are lining up in the same column. So now we're going to add those up as it says to do there. We get the numerator. So that being the 120. Now this is where we're going to deviate a little bit on the denominator. Instead of doing F plus P divided by 2, we're going to vary it, and then we'll do this one again in the second calculation. This way it seems to be a little bit more accurate. So you might see it in formatted this way too. The market price, the 800 times 60%, that gives us the 480. And then we're going to take the par value, the 1,000 times 40%. So the 60-40 adding up to 100. That gives us the 400. The 480 plus the 400 is going to give us the 880. And then I'll take the numerator divided by the denominator. Notice that's what I end up in my outer column in my little table worksheet. In the outer column, we got the 110 divided by the 880. There is rounding involved here, so keep that in mind. 110 divided by the 880 gives us about 12.5% if I move the decimal 2 places over. So that's close to what we got up top. Not exact. It is an estimate. Let's do it again, and now we'll see the bottom point here. We'll do the same thing, but this bottom component, we'll do it this way, F plus P divided by 2. So let's do it. That's another way you might see this. And like a book problem, if they try to take your calculator away from you and they tell you to, use this formula for the approximated way. And note, if they tell you to use the formula for an approximated way of doing it and you try to use a calculator, they'll be able to kind of catch you on that too, because it'll be different. The answer will be slightly different due to the rounding. So same thing here. Well, the numerator's on top. So same thing. C is going to be the coupon 90. And then we got the par value plus the market. That's going to be, minus F minus P. That will give us the 200. So same here so far. Then we're taking that divided by the maturity, or N, to get us the 20. The C plus that whole thing there, which is the 90 plus the 20. It's going to give us the 110. Then the denominator, we're just going to do the way they gave it to us here. That's going to be the market price plus the par value. That'll give us then the 1,800, and then we'll simply divide it by 2. That will give us the denominator of 900. So 1,800 divided by 2, 900. And then we're at the 110 divided by the 900. So 110 divided by 900. And that's about 12.22% if we move the decimal 2 places over. So that's the 12.22 approximate yield to maturity that you might see, versus the 12.5. This way, if the approximate's slightly different on the calculation here, versus the actual calculation, which we used Excel to do in multiple different ways. And again, in practice, of course, Excel is the way I would do it. That's the way I would think would be most common. If you're in a book situation, they might force you to do this kind of thing, because in a test-taking situation, that might be what they want to do, to give you not even a financial calculator and make you just calculate it possibly that way. They might give you this formula, or they might give you one that would be a little bit different. And just realize that when you do these calculations, even a multiple choice question, they could force you to basically do it whatever way they want to do it. by making the answers, multiple choice answers, different by the rounding, the differences in the approximation that you'll come up with by using the different methods. So just keep that in mind. In practice, that's kind of silly because usually it might be an estimate in and of itself. In other words, hopefully the difference is immaterial in practice. But in a book problem, they're testing for other things, whether you're cheating or something like that, right? Whether you use the calculator when you shouldn't. And so that means that they can change the answer. So just be aware of that. It's useful to be aware of, why they are doing that, right? Because they're doing that. Are you doing this for test taking purposes, or is this something actually applicable in practice? What would be the best thing to do in practice? What do I got to do to get through a test?